So the markets have had a really good year this year, but are we watching a slow train wreck? Let's find out. My name is Brian Cannon, and welcome to Markets in 5. All right, so I got several charts I want to go through today. We're going to start off with the S&P 500. So just to kind of get a quick update, despite this pretty nasty pull down earlier this year, the market's just been on a rip, and it's very much been a buy the dip scenario off the bottom. So every time the market kind of dips down and hits some sort of level of support, it was time to start buying. So I know there's a lot of concern, a little bit of angst around the market right now, but until we get a certain breakdown with several of our indicators, the coast is clear. So again, what are we looking for? We want to make sure that the RSI, the Relative Strength Index, stays above 50. This one time that it dropped down here on this major pull down, it found some support on the 50-day moving average. And so, again, great opportunity to buy and pick up some more stocks. And although it dropped below 50, it popped right back up and has continued to stay above that level. So again, we're watching these levels here. We want to make sure that RSI stays above 50, and we also want to look for levels of support, whether it be the 20-day or the 50-day moving average. Those would be good levels of support, and have held up well this year. So all in all, everything with the market right now looks pretty good. All right, so are we in the midst of watching a very slow train wreck? I think it's possible. Certainly all the news that you've heard lately is that lots and lots of companies, tech-related as well as non-tech-related, have begun investing into artificial intelligence in order to make themselves more efficient. And how do you become more efficient? You use technology that doesn't take a smoke break, doesn't take weekends and holiday pay. They just work 24/7. And so companies who basically are charged with driving profitability within their companies have very little loyalty to employment anymore. So if they can save a buck by investing in technology, they'll do it. And so we've seen the unemployment numbers begin to rise off the bottom. Now, granted, they were very, very low as a result of the COVID blip, but we are starting to rise. And so we want to watch those levels very, very closely, because you can see that oftentimes when the unemployment rises, especially sharply, that you see a drop in the market. And so we don't see a drop in the market at this point, but that is a level that we want to watch. And if we start to see unemployment begin to climb, then you can anticipate that the result is that the market is beginning to drop. So we need to watch this closely. And if this slow train wreck, this AI, comes and takes a lot of our jobs, then it is going to be reflected into the stock market. So we need to watch this level closely. Another chart here. It's the same chart. So it's the orange is the unemployment number. The pink is the S&P 500, and then we've also overlaid the Treasury yield curve, which is in the black. So I know it looks like kind of a messy chart, but the idea here is overlaying a different idea to kind of support the theory that when unemployment rises, the stock market generally is impacted. And so again, AI, they come, they take jobs. So when we have an inverted yield curve, that essentially is the 10-year versus the 2-year Treasury note. And when that drops down below zero, that means we have an inverted yield curve, meaning that rates are very high. And so when that happens, essentially, what is the government doing? They're trying to slow down spending. They're trying to cool off an overheated market, or they're trying to fight inflation. And so when COVID hit and so we started printing money, obviously that's going to impact the Treasury yields. And so essentially inflation has driven the yield curve to a negative inverted kind of arrangement. Well, as that inversion has now reverted, and now it's positive and starting to steepen a little bit, we need to watch that Treasury yield curve, because essentially you can see that unemployment and the Treasury yield tend to move in the same direction. So if we see unemployment rise, you can anticipate that the Fed is going to continue to cut rates. In other words, encourage people to start spending again. And as a result, you're going to see this market drop. So We've always had prior to a U.S. recession, there's always been an inverted yield curve. So we're coming out of this nasty inverted yield curve. Again, it's kind of an anomaly in the fact that it was a result of the printing of money in COVID, which is kind of a big experiment. So we don't know quite how that will end. But when you combine that with the idea that AI is coming and taking jobs, you can anticipate that once this unemployment number continues to tick up, that you're going to see the Treasury yield, continue to steepen, and then you're going to see the stock market as a result begin to drop over. So, again, I do believe we're watching a slow train wreck in front of our eyes. We just need to be very careful in how we're handling it. So, in wrapping up, we obviously don't know when this train wreck will end. But we do know that it probably won't end well. So it's going to be extremely important to watch your levels and have a process in place to mitigate that risk when eventually it comes. So, but if you have any questions, give me a shout, and I'll see you on the next Markets in 5.